The S&P 500 closes up a meager 0.08%. The Nasdaq actually drops 0.12%, and the Dow Jones Industrial Average edges higher by just 0.15%. The closing bell rang exactly 15 minutes ago on this Wednesday, May 13th, 2026, and I gotta say, today's tape is a total masterclass in deception.
Oh, 100%. I mean, if
Yeah.
you're only looking at those index level closing prints, you are completely blind to the structural violence that just occurred under the surface.
Right, which is exactly why we're doing this deep dive today. We've got a massive stack of institutional market wrap-ups, global strategy briefs, and the internal volume verifications from today's session. Our mission here is to decode this massive disconnect.
Because it is a massive disconnect.
Yeah, okay, so let's unpack this. The market right now is like a duck on a pond, right? It looks perfectly still above the water, but underneath it is just paddling frantically.
That's the perfect way to phrase it. For anyone managing a portfolio right now or, actively trading the tape, today is exactly why you can't just trust the scoreboard. We are looking at a market trapped in this fierce tug of war between AI resilience on one side.
And a very harsh macro reality on the other.
Exactly.
So let's start with that macro reality. The surface level was just a choppy mess today. We basically flatlined. But the strategy briefs are pointing to a highly toxic environment driving all that chop.
Yeah. The term the institutional desks are tossing around today is valuation stalemate. Because we got a significantly hotter than expected wholesale inflation print this morning.
The PPI.
Right, the producer price index. It jumped 1.4% month over month. And I mean, that is a massive sequential acceleration. It immediately spooked the bond market.
Yeah, sent the 10-year Treasury yield spiking right up to 4.48%. And, let's pause on that 10-year yield for a second, because we talk about it constantly. But for you listening, if you're looking at your models right now, how does a spike to 4.48% mechanically paralyze the equity market?
Well, it all comes down to the cost of capital, right? The discount rate. Every institutional valuation model prices a company's future earnings against the risk-free rate of return, which is the 10-year Treasury.
Right.
So when that risk-free rate jumps, the present value of all those future earnings just drops. Suddenly, growth stocks look incredibly expensive.
Like they're completely mispriced.
Exactly. Wall Street liquidity looks at that 4.48% yield. They look at a Federal Reserve that utterly refuses to signal a pivot, and they decide to just, sit on their hands. I mean, why aggressively bid up equities when you can get a guaranteed return in bonds while inflation runs hot?
You don't. You sit on the sidelines and wait for the smoke to clear. And we saw that macro fear manifest really clearly in the sector rotation today. Money aggressively rotated out of consumer discretionary and just poured into utilities.
Yeah. Utilities caught a bid early in the session and literally never let go. When portfolio managers feel macro risk escalating like this, they seek out defensive yields.
Right, the safety plays.
Exactly. They buy the companies that generate power and pay reliable dividends. Completely, regardless of what the broader economy is doing.
But I want to push back on the other side of that trade for a second, because consumer discretionary lagged hard today. And the prevailing narrative has been that the consumer is incredibly resilient. So why is institutional money suddenly dumping retail names?
It's the margin squeeze. The strategy briefs highlight this heavily. When you have 6% annual wholesale inflation staring you in the face, which today's PPI print just confirmed, companies face a really brutal choice.
Right. They either absorb the higher cost of goods, which crushes their margins,
Or they pass those costs on to the consumer. And the internal data is suggesting the consumer has finally hit a breaking point. They're rejecting the higher prices. So retail forward guidance is just getting drastically revised downward across the board.
the market is finally pricing in the reality that discretionary spending is hitting a wall. Okay, so we have sticky inflation, we have rising capital costs, an exhausted consumer, and supposedly real money is sitting out. If that macro picture is so bleak, how do we explain the volume profile?
The volume was wild today.
It really was. The verification from today's session tracks roughly 7% above the 30-day rolling average. That is a ton of capital changing hands for a day where the S&P basically didn't move.
Right, but the volume wasn't broad. That's the key. It was incredibly concentrated, and almost all of it hit the tape going into the close, like the final 90 minutes of trading.
Yeah.
This was a structural reallocation away from the broader market and directly into the semiconductor and megacap growth space.
The intraday charts on those specific names are just crazy. If you look at the semiconductor ETF, the SMH, it started the day deep in the red.
Looked like it was going to completely break technical support.
Exactly. But then heading into the close, we get this massive volume confirmation, a total key reversal. NVIDIA surges, up 2.8% on the day?
Yeah.
Micron jumps 4.3%. Both of those names opened at the absolute lows and closed at the highs on surging volume.
which forms a textbook bullish outside day. The sellers who were reacting to that hot inflation data early on, they just became completely exhausted. And the buy-side algorithm stepped in, absorbed all of that selling pressure, and just overwhelmed the order book.
And here's where it gets really interesting,
Yeah.
because that reversal wasn't spontaneous at all. The catalyst was Cisco.
Oh, absolutely.
They printed what the strategy brief literally calls a Godzilla earnings beat. We're talking about a 12% jump in revenue and a forward guidance raise that included $9 billion in new AI orders.
Yeah, that Cisco print is the skeleton key for today's market action because up until that earnings release, there was this lingering anxiety that the massive capital expenditures from the hyperscalers, Amazon, Microsoft, that it wasn't actually translating into widespread downstream revenue.
Right, that it was all hype.
Exactly. But Cisco just proved that the infrastructure spend is real. It's massive. And it is hitting the balance sheets of the networking providers right now.
And that triggered a massive structural event at the end of the day. The internal verifications show a colossal mark-on close, or MOC, buy-side imbalance. Institutions were just aggressively hitting the ask, buying at market price right as the bell rang.
And when you see a buy-side MOC imbalance of that magnitude on a day where the 10-year yield is spiking, it tells you everything you need to know about institutional psychology right now.
The FOMO is real.
The fear of missing out on the AI infrastructure supercycle has completely overridden their fear of the Fed. They're basically making a high-conviction bet here.
Yeah, they're granting AI companies a total exemption from the laws of macroeconomics. The cost of capital is rising, which is supposed to hurt tech. But the consensus is that the productivity gains from AI will simply outrun the drag of inflation.
It's a highly specific bet, though. Portfolio managers are concluding that if you aren't allocated heavily to AI infrastructure right now, you are going to severely underperform the benchmark. They're forcing capital into these mega-cap names, regardless of the macro deterioration.
But the real risk here is what that does to everything else. If capital is only flowing into 8 or 9 specific companies, the structural integrity of the broader market has to be failing, right?
Oh, it's rotting from the inside out.
Let's look at the breadth data. Because the NYSE advanced decline ratio closed today technically green at 1.1 to 1. But the briefs point out that the Titan 8 megacaps provided 85% of today's positive index points.
It's a total breadth deception. The index level is a mirage right now.
Right.
We have a hollow rally being propped up by a skeleton crew of monopolies.
So for you listening, how do you actually measure that weakness? If the S&P is technically near all-time highs, but the average small and mid-cap stock is catching zero bids and just drifting lower, what's the metric that exposes that?
You have to look for bearish divergence.
Yeah.
I mean, the S&P 500 actually printed a marginal new closing high today. But if you look at the cumulative advanced decline line, which measures the net number of stocks going up versus going down, that metric actually peaked 3 entire days ago.
Wow.
Yeah, and it's been trending lower ever since.
Meaning the price of the index is climbing, but fewer and fewer individual components are actually participating in the move. The foundation is crumbling while they're still building the penthouse.
Exactly. And market history provides a very clear lesson on this exact setup. Price eventually follows breadth. You just cannot sustain a market advance indefinitely if only the largest components are absorbing capital.
It's impossible.
Right. A bearish divergence of this magnitude is the classic mechanical signature of an exhausted trend. It suggests we should anticipate a structural mean reversion pretty soon, likely pulling the index back down toward its 50-day moving average.
Which brings us to the most glaring paradox in today's data stack. If the internal plumbing is leaking and breadth is failing and we're staring down a 1.4% jump in wholesale inflation, why did the VIX drop 6% today?
Yeah, down to 13.4.
Right. I mean, by historical standards, a 13 handle on the VIX is an extreme level of complacency. Why isn't anyone panicking?
Because of Volt Rush. It's an institutional mechanism. We had 2 major macro data releases this week, right? The CPI yesterday and the PPI today. Once those known binary events pass, the uncertainty is temporarily removed from the market.
So the event risk is gone.
Exactly. And when that happens, institutional options desks immediately step in to sell premium.
Okay, let's break down what selling premium actually looks like in practice for the active traders listening.
Sure. Think of the options market like the insurance industry. Institutional desks act as the insurance providers. They sell options contracts policies, and they collect the premiums from the buyers.
Right.
Because the known macro events have passed, these desks feel confident that a sudden crash is unlikely in the immediate term. So they flood the market with option supply, just harvesting that yield. That massive influx of supply crushes the implied volatility of the options, which mechanically forces the VIX lower.
So the VIX at 13.4 isn't necessarily a sign that the market is inherently safe. It's just a mechanical byproduct of dealers harvesting yield. But wait, if these massive institutions are acting as the insurance company and selling all these policies, who is taking the other side of the trade? Who is buying them?
The smart money. Because the VIX has been crushed down to 13.4, downside protection, specifically put options on the broader index, is currently the cheapest it has been all quarter.
Wow, okay.
Yeah, highly sophisticated funds aren't using this low volatility environment to aggressively buy the S&P at all-time highs. Instead, they are quietly accumulating massive positions in cheap downside protection.
They are buying fire insurance while the sun is shining.
Exactly. They see the bearish divergence, they know the breath is hollow, and they're leveraging the artificially low VIX to hedge their portfolios for pennies on the dollar.
Right, before that mean reversion actually hits.
It's a highly asymmetric trade. They cap their downside risk for almost nothing, anticipating that when the structural breakdown finally happens, the value of those put options will just explode.
Okay, so we've got the underlying reality decoded. We know the tape is deceptive, the volume is heavily skewed toward this AI exemption, the breadth is failing, and smart money is quietly hedging. So what's the look ahead? If you're logging into your brokerage account tomorrow morning, how do you actually navigate the open?
Well, the first rule for tomorrow's session is you have to respect the mechanical ceilings and floors. Right now, options dealers are heavily long gamma.
We see that term in the strategy briefs constantly. Let's briefly explain the physical mechanics of long gamma. How does that positioning actually restrict the index?
Think of long gamma like a highly aggressive automated smart thermostat in a room. Options dealers are required to maintain a neutral risk profile. They can't be exposed to major directional moves. So when they're long gamma, their hedging requirements mechanically force them to trade against the prevailing trend.
So if the market gets too hot and starts to rip higher?
The dealers are forced to sell equities into that rally to stay risk neutral. They act like the air conditioning kicking on, cooling the price down. And conversely, if the market starts to drop, their models force them to buy equities, acting like the heater turning on.
Which just traps the index in this really tight, artificially regulated price range.
Precisely. And the internal data outlines exactly where those boundaries are set for tomorrow. The primary call wall, the resistance ceiling where that dealer selling will be the heaviest, is sitting at 7,450 on the S&P.
Okay, so any broad market rally tomorrow is highly likely to stall out exactly at 7,450,
Yeah.
unless we see some overwhelming, coordinated buy-side volume surge that just blows through it.
Right, which is unlikely. They will cap the advance right there.
And what about the floor? What happens if the heater breaks?
The critical support level, the put wall, is at 7,350. That is the absolute line in the sand. If the S&P 500 drops below 7,350, the dealers instantly flip from a long gamma posture into a short gamma posture.
And short gamma flips that entire thermostat dynamic upside down.
Brutally so. In short gamma, dealers are forced to trade with the trend to hedge their books. If the market drops, they are forced to sell. That mechanical selling pushes the price even lower, which forces them to sell even more.
It creates a cascading feedback loop.
A total forced liquidation loop. The strategy brief projects that if 7,350 breaks, the structural selling will trigger a rapid slide straight down to the 7,270 zone.
So buying the broader index tomorrow is essentially dead money. You're boxed in by the 7,450 ceiling, and you carry the catastrophic risk of a short gamma cascade if we break 7,350. So where is the trade? How do we find idiosyncratic alpha when the major averages are pinned?
You look at the Cisco ripple. The market isn't buying broad equities, but it is aggressively buying the second wave of AI infrastructure. The investment thesis is migrating right now.
It's no longer just about the semiconductor chips.
Right, it's not just NVIDIA anymore. Yeah. Capital is shifting toward the underlying networking plumbing that actually connects those chips inside the data centers.
And the strategy brief specifically flags Arista Networks, ticker ANET, and Juniper, ticker JNPR.
Yes. The setup for both of those names tomorrow is a 30-minute opening range breakout. So you watch the price action for the first half hour of trading. If they clear their morning resistance levels on high volume, you enter the trade, defining your risk strictly against Wednesday's high.
And the expectation is a multi-day price re-rating based on that Cisco CapEx validation.
Exactly.
There's also a very specific day 2 play highlighted in the brief. Applied Materials, ticker AMAT. They report their earnings Thursday, post-market.
Right, the setup on AMAT is a sympathy breakout. You want to watch the $445 level. If the stock clears $445 on solid, sustained volume during regular trading hours, you are basically witnessing institutions front-running the earnings report.
They're calculating that Applied Materials will benefit from the exact same spending wave that just lifted Cisco.
Yep, and they are positioning themselves before the numbers actually go public.
Okay, let's talk about the statistical probabilities for tomorrow's session as a whole, because the historical data here provides a massive warning sign. Statistically, there is only a 33% chance of a back-to-back trend day.
The math is unforgiving. Just because we saw a violent directional move into the close today does not mean Thursday will blindly follow suit. In fact, there's a 70% probability that we see an opening drive in the same upward direction for the first 90 minutes, mostly driven by overnight momentum and retail traders reacting to the headlines.
But the trap shuts at lunch.
Exactly. The data shows a 67% probability of a midday mean reversion. The institutional algorithms will step in, absorb that morning retail liquidity, and just fade the move back to the volume-weighted average price.
So the tactical takeaway for you listening is crystal clear. Do not chase any upward index moves after 11:30 a.m. Eastern. Trade the specific AI networking setups, respect that 7,450 gamma ceiling, and keep an incredibly close eye on tomorrow morning's jobless claims data,
Yeah, because one crack in the labor market changes the Fed's math instantly.
which could easily trigger that short gamma cascade we talked about. The scoreboard you see on the financial networks tomorrow is going to be a mask. The major indices might look perfectly calm, but the internal foundation is actively fracturing.
If you want the ultimate lie detector test for tomorrow's market, just pull up the equal weight S&P 500 ETF, ticker RSP.
Right, because the equal weight strips away the outsized influence of the Titan 8. Every company is weighted exactly the same.
Exactly. If the RSP breaks today's lows while the main S&P 500 stays green, it confirms that the megacap rally is a complete trap.
And that broader market failing underneath brings up a really critical structural question to leave you with. We know institutional capital is entirely hyper-focused on those tech monopolies right now. They are aggressively forcing liquidity into AI. But by doing that, they are actively starving the small and mid-cap sectors of vital capital.
And they're doing it during a period of 6% annual wholesale inflation, which is exactly when those smaller companies need access to capital the most, just to cover their soaring operating costs and survive the margin squeeze.
We are basically witnessing a massive, silent capital reallocation. If you step back from the daily gamma levels, the long-term implications are just staggering. If mid-cap companies are catching zero bids and are locked out of cheap financing, what happens to the next generation of non-AI innovation?
We might be inadvertently engineering an environment where only the current tech monopolies have the cash reserves necessary to survive a higher-for-longer inflation world.
The engine is overheating, and only a handful of passengers are allowed in the lifeboats. Keep your eyes on the plumbing tomorrow, watch that equal weight index, and whatever you do, don't get caught chasing the tape. We'll see you after the bell.